What a miserable day. I wasn't planning on saying that to start this off, but what an incredibly miserable day this was. All on inflation news, and I thought I would just start with a couple comments there, and then I really want to roll into what we want to talk about today. Because it's rare to have a down 1,000 day, even though the Dow is at 30,000. It's not, in percentage terms, it's not in the top 10 or 20 or 50 of all time drops. It's nothing like that. But it still is headline news, and we're going to talk to death about it. I'm sure there'll be market crash headlines on CNBC, a new show for tonight or whatever. And I don't know if it's going to continue. No way to know. But we had such a good week last week, and it all was like gone in a day. So it's all wiped out in a day. All because inflation is like a little bit higher than a couple analysts that have no idea what's going to happen, because none of us do. Decided that it was supposed to grow by 7.8 and went up by 8 or something. Actually didn't miss by a lot, but it's higher. And does that really matter to iPhone sales? No, not actually. No, I think Apple has proven to go through recessions and inflationary periods and continue to sell more stuff that we love to buy. Interesting. I don't know what it's about. I do know that as I look at the market today, everything got crushed. The inflation is ripping higher, and gold, which can't get out of bed. I mean, it is stuck at 1,800 through all of this past year's inflation, all of what's going on in Russia and so on and so on. Geopolitical events, go to gold. If there's inflation, go to gold. If you're watching Fox News, you got to go to gold. Why? Because apparently all conservatives are doomsdayers. It's weird, but that's you know how many commercials they have running on that. It's just terrible. It's terrible. But none of it's working. I mean, everything is crushed, which I don't know if that means that the market is going to rise tomorrow, it's going to fall tomorrow. There's no way we would know anyway, because the market's been very strong lately. But what I do know is that all of the strategists will get on TV tomorrow and tonight and tell everybody basically how bad it is, pretending that they were out front of this 1,200 point decline. And they're not. They weren't. But 10 days ago, everybody uniformly was absolutely certain, without a question, that the market had to go down, which led to another peak of pessimism moment. We talked about peak of pessimism last time, and I'll show you a couple charts today to kind of talk about that. But was an amazing time. Everybody with absolute certainty, strategist after strategist, got on to tell us that the market had to go down, and laughed at anybody or anything that people thought a few months ago that was optimistic at all. Literally, very arrogant, which of course, the market jumped 5%. Now today we miss on a tiny number. It's not like inflation just showed up. It wasn't accurately projected by a small amount, and the market craters. There's nothing to say good about today. Oh, well, it was kind of like, no, it wasn't confined to this or that. Everything got slaughtered. It's not like utility stocks went up and consumer durables went up. They didn't. They didn't go up. It was a terrible down day. Everybody sold everything from Bitcoin to gold, silver. I don't know, maybe zinc was up. I didn't look. But the point is that everything went down. Nowhere to hide. Nowhere. And when we get days like this, they seem to be an overreach. So I just wanted to comment about that. It's just, it doesn't make any sense on a fundamental scale. So inflation is running a little bit hotter. It wasn't yesterday. It was. We just didn't choose to overreact yesterday. And that's not a prediction that's going to bounce tomorrow. It's just saying these are days that happen. Traders' positions were maybe on the wrong side, and so they quickly had to scramble and cover. Futures were leading the whole way because you saw the whole market just float down together, meaning that was driven more by futures contracts and individual determination on stocks. I mean, why would Amazon be worth 6% less today than it was yesterday? Well, according to the market, it was. Doesn't make any sense. It isn't. So when we get days like this, they're very disconcerting. I totally get that. And I wasn't going to pretend, that we didn't have a terrible day today. But I do want to talk about the fact that not just peak of pessimism, but let's start with kind of a traditional, if you will, a long time quote that is super true. And we just don't think about this very much. You make most of your money in a bear market. You just don't realize it at the time. Now, Shelby Davis is a legendary Wall Street investor. You may have heard of Davis Funds. His son, Chris, now runs it. It is something else when you think about how difficult it is for people, even though nobody would say, I want to sell out at the bottom of the market. That's my plan. Nobody thinks that. Nobody does. Of course you don't think like that. Why would you think like that? But we do. When markets go down and the news is bad, we do what? We worry a little bit, and then we go get more data. So we rush to get more data, which confirms how bad things are, right? I mean, we now have confirmation. I am armed to the teeth with data about how bad the world is. Because what? I read the headlines of today's newspaper. It's not hard to find. But what we forget is that the market is a discounting mechanism. It already reflects collectively what the market believes is going to happen, how bad it's going to get. I talked about this on Saturday. It's not like you go into the market one day and find that the market is down. And it's because of inflation, like it suddenly happened. Now, today, it may have been an exaggerated move of that, but not really. It's not the reason. Inflation is just this much hotter. Therefore, we need to crush the market. But the idea that the market is not discounting a recession, it's in there. It's what markets do. If you say, well, what if we have a recession? Yeah, okay, well, I think the market's predicting we will. Yeah, but what if we do? Then probably the market won't do anything. It is predicting it. That's why we're down 25% at the peak. But we live in the here and the now, and that's why it's so hard, I think, for us to make that connection in there. And when we also think about markets, we think that they're normal. Now, Jen, let's go ahead and put that slide up again, because I want to walk through this. And what is it, Jen? For 20 some years, we've been updating this chart. I mean, it's just been probably since you and I worked together. It's been forever, 26, 7 years. Anyway, the point is, we continue to update because it just became this fascination to me of how in our minds, the human mind, we think of 10%, which again, that you're right. It doesn't matter what long-term time frame we're in. It always has this. The market has this gravitational pull to 10%, like the equator does, right? It just boom. For 80 years, for 60 years, 23 years, whatever. It's like always there. And when we think about the market, so the human brain says that looks like this. And it doesn't look like this. And so when you think about how markets react, you would think over roughly the last 100 years, a lot of times the market would be like between 8 and 12% because the average is right in the middle, 10. I'm not asking it to be like right on 10. I'll give you 2 points either way. And it's only 6 times, like 6.5% of the time. That's it. Like almost never. Like any bet you want to make, you would never bet this, that the more market would be normal. And so we have this really skewed, because the way our brain works is not like markets do this, to equal this 10% over time. That's the way the brain is. That's how you track food, right? Tracks, food, boom, shoot them. You got it. And now you eat. That's the way our brains work. They don't work in this non-linear way. So it's hard for us to have that concept, but I like to point this out. Now let's go, and if you will, what people think like low returns in the market. Okay, there's a few of those. And then we have the losing years, right? Like bam, bam, bam. And then you look down, oh my gosh, look at, I mean, how many years are you losing? Like a ton of money, like 12% or more, like we have so far this year. Not very often. Not very often. We act like this is predictable. We could, everybody should have known it. Inflation was coming and blah, blah, blah. But you know what we've lost this year? Less than we gained last year. But Crazy Joe was in charge and the inflation was going away and all these policies and stuff. Got it. And the market went, what does that have to do with how many iPhones are sold? It doesn't. So we're in a period that is down more than normal. And the real question we ought to ask ourselves is not like, wow, do we sell out? No. If I might add, duh. No, of course not. We don't wait for markets to go down a lot and then sell. Well, should we be shifting our portfolios and changing? We'll talk some more about that because some things are changing out there that are going to be other opportunities for people. But let's go ahead and this is what I really want to show. Look how many years are up. Like pretty good, more than market average. Now this is the one that kills you. How many times over 20%? Yeah, that's what you can't miss. This is where your returns come. Right there. It's not from avoiding the down. It's right here. It's right there. Who thought we'd have 26% after being down 20 in the first quarter in 2009? Nobody. Nobody. But if you miss it, you miss a lot. You miss a ton. And we've seen this chart a zillion times. I'm sorry, I can't help myself. You have to watch it again. 20-year periods, you miss the 10 best days, your returns are cut in half. That's just returns. And when you compound at a 50% less number, as you can see, it's less than half the money. What if you miss 20 days? You see it. You get the point. Here's the big point, though. The big point is people think, yeah, but I could, what if I miss the worst days like we're having right now? Like, what if I miss this day? Then you missed last week. Because the best days are right next to the worst days most of the time. Most of the time. Nobody can do that. Nobody can do that. So when we get in the right perspective, again, I'm not trying to time things and to recognize you can't, and that the quotes economists can't even get right what interest rates are going to do. They've been wrong more than a coin flip. I am not joking. They've measured them for 20 years. It's ridiculous. They can't. But we listen and try to grab more data. The reality is the best thing we can do is to sit back and recognize what you have to do is you build a portfolio for what makes sense for what you're trying to do. And when I say that, what I'm really driving at is if you're taking income for life, cost of living adjusted that you can't outlive, which is what most people are trying to do in retirement. If there's some money left over, great, the kids get it. But nobody knows how long you're going to live. And we ran into this today with a gentleman that just had a really hard time with a spreadsheet and the concept that he could spreadsheet his way through life. You can't. We use spreadsheets. Well, Jennifer's really good at spreadsheets, but she still, with all that, doesn't have any idea when you're going to die, how much money you're going to have left when you're theoretically 87.3 years when you drop dead. But the problem is people don't drop dead at 87.3. They live to be 95 or they die at 80. Sorry, spreadsheets don't do that. They also don't show you the sequence of returns. Did we make 27% this year and then lose 8? And then somehow magically the other numbers in between equaled 10% long-term return. What does that mean? Nothing. It means nothing when you're taking money out. Because when the market's down 10% and then you want to take another 5, you're now down 15. In other words, the pile shrunk, and now maybe you get another low return year and you take another 5 out. And now the market starts to come back, but your pile's too small to capture that. So what we have to do is we have to put little things aside. In other words, when markets are good, you're thinking out 3 to 5 years. You're thinking about the next correction, not what are we going to do now? We need to be planning for that. And that's really, I guess I want to drive that point home. You don't change because the market changes. You may change investments over time, as we're going to discuss in a little bit, some of the opportunities that are coming up because interest rates are rising, because there's volatility in the world. We have new investment themes that we can use. Seriously interesting things when times are volatile. When times are not volatile, guess what? The deals aren't very good. So we don't do them. The best way to think about it is, if you will, like the wall behind me is a wall of different weapons, right? And we may have weapons of like bonds we might use. Well, we haven't used in a long time. That cupboard, that door, cabinet, however you want to see it, it hasn't been opened for a long time. But we're thinking about cleaning it off to take a look as interest rates get more interesting, especially in high yield bonds. We're not there yet, but that's the way we think of it, where right now for the last 10 years, we've used almost nothing but equities. Now, dividend paying equities, we're using now some interval funds with real estate and things like that. Why? Because private real estate doesn't go bump in the night. It kind of like sits there. Private real estate is up 11% this year. Yeah, you didn't mishear me. In a world where the market's down 20%, because it was 15 like yesterday, is now back up to near 20. It's up 11. Now that's a nice place to go when we're trying to draw income, right? When the market's down, because if you want to cause a death spiral, we sell down. We don't. So we planned. Do we think it's going to go up 20% when the market goes up 20? No, it doesn't. Doesn't do that. It's not supposed to do that. So different components do different things. And that's what I mean by a portfolio. And as time changes, we're not guessing what weapons we should be using. Sure, of course, you analyze, it's cheap, it looks like the outlook is good, blah, blah, blah. But the reality is the market tells us, the economy tells us, interest rates at 1%. Hey, here's a news flash. That won't work. It won't work. You can't put 40% of your portfolio into bonds when they're at 1%. Can't do it. So people who are in retirement are in stocks, like all stocks, maybe some interval funds and stuff like that I talked about, right? But when we get into these periods of time, one of the things that's really fantastic for us, right, is we might be able to hold a little more cash now. Why? Because we can almost get the inflation rate, the long-term inflation rate now. We can get like 3% almost on ultra short-term mutual funds. What does that mean? That means they're not like 30-year bonds that get crushed when interest rates rise, okay? Don't have to worry about that. These are more current interest, more like cash-like, okay? They don't move around, they just sit there and pay interest. But now we've seen, with interest rates being raised by the Federal Reserve, we're getting up to 3. That changes the mathematics now of being able to hold some cash or cash-like. Can you hold cash? You tell me, how's your bank paying? Because if yours is doing more than 0.1, like mine, I'll change banks. Nobody's paying on cash. I don't care what you are, where you're at, because they don't need more cash. The world is awash in cash. Why? Because everybody's afraid. One reason is that they are. People don't know what to do, and they have been that way for years. Trillions of dollars have been earning zero in U.S., basically zero, in U.S. at tens of trillions on corporate and personal balance sheets. So when people talk about the world ending, it sure isn't going to be a balance sheet problem like 2008. It is not. We're so liquid, it's ridiculous. Is inflation, and which is another reason why inflation is such a big problem. It is an enormous problem, and it's going to take more than the Federal Reserve raising interest rates, destroying the economy, which is what they're doing, to get a handle on it. That's the money supply problem. We talked about that on the last Zoom, I believe, or one of the last two. You can go see those, by the way, on YouTube, Petso Financial, if you missed anything you want to catch up on. But you will see those that are absolutely, you cannot believe how much money we've printed. Now, this is not a political statement. It's just a statement of fact. You can't get away with this. I know that there's a group of people, and yes, they are on the left, that thought that they could print and print and print and print, and it would not have any effect. It always has an effect. Milton Friedman taught us that it simply will have an effect. But the Federal Reserve is doing little in regards to clamping down on the money supply. So I do believe that inflation will be more persistent and higher than it is going to be thought of. But let's face it, the core inflation and other things, and we don't have slides for this today, but I just wanted to let you know that about half of our inflation is really not core inflation. It's transitory. It's things that move up and down. It's energy prices. Energy is a decent sized part, but there is enough that is really there, is not transitory. It won't be going away anytime soon. That'll continue to be fueled by too much money supply out there. There's just too much money, and there's a bunch of money earning zero. So anyway, I just wanted to say you will start seeing some things in your portfolios, and also if you're hiding cash under your mattress or in your bank, don't do it. It's okay. We're not going to make you put it in the market, but we need to earn something on that to try our best to keep up with inflation. And now you can for the first time in 10 years. It's crazy. It's crazy. But we're hearing people talk about CDs and things like that. I don't know why you'd buy a CD and tie up your money for a couple of years, especially with rates rising, when you can do it in short duration bonds and earn actually more and have daily liquidity. So with private real estate and things like that, that's kind of those are kind of outliers. I don't want to get caught too far in the weeds, but I did want to kind of mention that you're going to see some of those things in portfolios that haven't been there for 10 years. So let's talk about a couple other things, Jen. Let's go to our next slide. I want to just touch on this real quick. I talked about this before because it's peak of pessimism. I know I keep talking about it. I want to talk about it. You don't know the actual peak of pessimism because as we look at any of these lines, you could say anywhere along there is way below the average and is really, really, consumers are not confident, right? Anywhere you could go along there. So when we look in hindsight and measure from the dead bottom, well, markets do really good. 25% is an unbelievably high 12-month average return. It's just remarkable. So what I'm saying here is when you feel really bad, buy. History says it always works, okay? And it works in big time. So I'm not saying that this dot on the far right isn't going to make another plunge and go even lower. But all-time low works for me. When I'm trying to compare the reality that consumers' sentiment is the worst indicator of where the market's going to go. Or is it better said, that's the best one, the best counter? When people are super nervous, markets take off. I don't know if that's peak of pessimism, but it sounds like a good one to me. All right, so that's our one. And let's go to the next one then. I don't know. I can't help showing in different ways how bad we are. We are so bad. We are just terrible investors. Well, I like real estate. Then buy REITs. Top performer for the last 20 years is real estate. Now, this isn't privately owned real estate. This isn't your house. Sorry, it's not. This isn't your rentals. It's not. These are publicly traded, public storage places, data centers, industrial complexes, professionally run office buildings, all those things. That's there. But they're traded stocks on the exchange. That's it. As much as we hate, and we do hate emerging market equity right now, it did really good over the last 20 years. It really did. Even though it's been so dismal for the last 5 years. It's been terrible. But look at those returns. It's just crazy good. But the average person, by their intelligence, reading, digging in, watching TV, getting into that data, realizing how bad the world is, 3.6. Now, what is that a measurement of? It's a measure of money going into the market, out of the market, at various times based on what the market then does. The average investor's return is 3.6%. I've quoted this many times. I got to tell you because it's so funny. So Fidelity did an investment, did a study of all of their investors over the years. You know, they sliced it and diced it a million different ways: men, women, minorities, college professors, doctorates, undereducated, no high school, all of them sliced and diced. Because one of the things is you have to know your investors, right? You have to ask certain questions. So they were able to do this, ran all the data. And literally, there's like no difference, like college educated, engineers, whatever it is, right? And probably those of you who are engineers, you probably know you're not very good investors anyway, because you can't prove anything with this. You know, I mean, the bridge can't go down. It can't. It has to be 100%, can't fall. In investing, if you're right just a little bit more than you're wrong, you're like a legend. Okay, it's a game of misses, and engineering's not. But anyway, so sidebar though. So what I'm trying to say though is that we are just so bad at this, and we just don't recognize it because we get caught up in all of the stuff out there. We really do, and we think we're being smart by sitting around reading and learning more and more and more all of the time. Bad news sells. It really does. And we got to be careful with that. There's no question. It really does. And when times are bad, they yell a little bit louder. It's really more exciting. And ratings go up. They really do. They go up during elections. And they go up when the economy and markets or wars or whatever it is are happening, when bad news is really prominent. I've said this before, and I don't want to dance around this, and we're going to grab some questions here. So if you have them, queue us up and let us know. You know, shoot in a chat question or what have you, or raise your hand. But we are in a circumstance, in a world now that the average person doesn't think we're on the right track. And I most certainly don't. Now, are we on the right track with biotech discoveries and creating an amazing platform for outer space to be beaming high-speed whatevers, the Internet of Things, artificial intelligence that either, you know, becomes self-aware, right, and kills us, or we become able to utilize it to solve the world's biggest problems? All of those things are true. In a world where everybody feels is upside down, where if you're a certain skin tone, you are promoted, or you're told you get to be a board member. If you gender identify in the right way, then then the NASDAQ wants you to be a board member. Not because of qualifications, just because that's what we do. And I don't know anybody in business that thinks that that's a good idea economically. So we're in a place, not just with social issues, but policies and inflation that are out of control. We spend trillions of dollars and with no thought about what that's going to do. It's upside down. It's wrong. Everything is, and it does absolutely feel like it can't get better. But corporations absolutely always do work around this. And I have to remind myself that all the time. I just wanted to say, I don't feel any different than you do. I feel it. It feels wrong. It is wrong. We're on the wrong track. And it's not just you and me or some political party. I believe it's over 70% of the people polled think that. Well, that's just not all a bunch of right-wingers. That we're on the wrong track. This isn't going to work. But I have to believe that things are changing and will change because they always do. And most importantly, I always bring myself back to this. What does inflation, what does any of this noise have anything to do with how many iPhones are going to be sold this quarter by Apple? How many subscriptions are going to sell for their zillion different things? at 99 cents each. It's a lot. And that's what the driver of the market is, not a bunch of egghead politicians with moronic ideas. And most of them have never done it, a darn thing in their life. They have no idea how to build a business, run a business. They're flipping bureaucrats with power. They still can't wreck it. They still can't. This country is that strong and that great. There's no question in my mind. With that, let's take some questions.
Well, before we do, you have to finish the fidelity survey. I don't believe you said who the best investor was.
Are you kidding me?
I think you went engineer and then you were done.
Wow. Okay, I'm sorry. Apparently I'm getting old and now I'm enfeebled and drifting off onto different things. Okay. So I'll bet you a number of people out here have heard me say this before. Okay. There is one group. Okay. It's the people that forgot they had an account or are dead. That's the best investors by so far. It's not even close. That is what you're fighting against in your human nature. And the more you read, the more you look at, I'm sorry, but the worse you're going to be.
All right, now questions. All right, given
All right.
that
Thanks, Jennifer. That's a little embarrassing, but it's okay.
Well, we had to finish it.
I did have to finish. It's a great story. I have no idea how I got lost.
All right. So given the Fed's move to electric vehicles, will we be slowly selling off oil stocks?
No. It's an interesting question, but it will take, I believe the latest numbers are almost 2 decades before we hit peak oil use in the world. Not before we have none, before we actually stop using more. That's a long time, and that is not the end point. Now, do I think it'll be quicker? I do, because that's the way technology works. I think it'll be quicker, but we have such a massive problem with our grid. All we have to do is look at California. Now, I know California is a complete basket case of complete morons for decades. How you could take a state that's the richest in everything in the whole wide world and a giant coastline and run it in the ground like they did. Only human beings could do that. Only politicians could do that. And they did. And it is stupid. But that's not just their grid. Now, Texas, I don't think they're exactly, kind of just so nutty that they can't possibly manage anything. They run into trouble on their grid. We all are going to, as we get more and more people and we don't have the infrastructure. So we all try to run on electric cars. Won't work. It won't work at all. We can't even power the ones in California. You're not allowed to, you shouldn't. I don't know how they stop them, but they're not supposed to be charging during hot time. Oh, so I'll just sit around and not charge my car and wait till 2 a.m. to do it. It's insane. It needs to be fixed. But the point is we're not going to say no more cars. We are going to say we can't build enough. There's not enough lithium. There's not enough of the other stuff, at least not now, until technology says, hey, this will work. We can build the batteries smaller. We don't need as much components. And also, we also forget about the fact that if we want to have clean everything, the world is a lot cleaner than it was 10 years ago. It's with more people. It's a ton more cleaner than it was 20 years ago. It's not even close. It's not even close. We use a lot less, if you will, carbons than we used to. So we're doing very well with reduction. What we've got caught on this is it becomes a political discussion instead of a real solution-driven thing. Like, let's go ahead and solve problems. Let's talk about this. Instead, it becomes we have to have all these cars, which we can't. Anyway, an electric car right now, a Tesla, burns more carbon than it saves. Yes, because they have to actually make the thing. And then they have to dig up the lithium and they have to dig up all the stuff to put it in the car. And it doesn't even include what are we going to do with all those stupid lithium batteries. I guess we throw them in that 5-mile deep crevice in the Pacific Ocean, or 6 miles or whatever it is. That I never can think of the something trench. But anyway, I don't know what we're going to do with them. Maybe we blast them out of space and kill the Martians that we think still exist. But that is a huge problem incoming. We can't just get rid of it. It's going to take something like I don't know, I'm best guess 15 years before we actually hit peak oil. It's not going to go away. No reason to be selling energy companies because of that. Okay.
Yep. So if REITs have done so well, why do we not have more in our portfolio?
Good question. They haven't done well right now, and we do have some, and we do have quite a bit now in these private REITs, which are not public. We are going to see more. We are buying some like Simon Property Group has a 6.5% dividend. But it's a pretty volatile stock. It was at 150 a year ago. So it's now down to 100. Still paying the dividend, but the point is that it's pretty volatile. What we are using is I'll just use the names because this is a group of our clients. So we're talking about Blue Rock. We're talking about Apollo, which used to be called Griffin. These are interval funds that are private real estate. Both are up for the year. Some components are down in one of them because they do use, for liquidity purposes, public real estate as well. But we can only get the money out quarterly. It's not a problem. It's just part of the management. But what is really nice is when we're in periods like this, we can use chunks of that if we're still down on top of the dividends that are coming into a portfolio. If people need money for the next 3 or 6 months, we just hit it on the quarterly, take the money out, and it's not down. Selling down is what we're trying to avoid. Okay. So we're using quite a bit of real estate, no doubt about it.
Right. So if Republicans take over in November, will the market come back in January?
Hard to say. I try not to put a lot on politics because then what I end up doing is having my own emotions and the things I want dealt with can get tied up in that. I think it comes back for a couple of reasons. It's helpful. It's helpful because we stop destructive policies. Okay. Nothing this administration has done. I'm not trying to make a political statement or make anybody angry. I'm really not. But raising taxes and raising regulations is a toxic chemical to the economy. It's toxic to business. And obviously, the decisions like Afghanistan have really hurt us geopolitically. It's emboldened our enemies. And it's made people that want to hurt us very rich with oil. I don't think that it hurts to stop some of that. Now, the commander-in-chief is still going to be Joe Biden. But the idea that they're going to pass more of this, I can't even believe the stupidity of calling it an inflation reduction bill or whatever they called it. It was debunked before it was passed. It is not anti-inflationary. It adds to inflation. Just like printing more money and throwing it into the system. It's just gasoline on the fire. It's beyond stupid. That will stop because they will take over and stop that. So that's what I'm more optimistic is that now the headwinds will stop. I don't think tailwinds will start. Look, if I was to be truthful about this, I think that the Republicans' policies are far better than the really bad policies of the liberal left. This is detrimental. That doesn't mean I just said that the Republican policies are good. They're not. That's not what I'm saying. So I don't want to throw all politicians in a bucket because I think that's ridiculous. It's just the same as calling men in a certain way and women in a certain way. They have characteristics, and most of those characteristics are not the kinds of things that lead to good policies. Okay.
Right. Are dividend funds mostly in retirement accounts?
Mostly, yes. And the good thing about it is that over the last 10 years, one of the best things we did was, of course, to avoid bonds because they just didn't work and don't work. And they're not working now in a rising interest rate environment. So we're really pleased about that. But we're most pleased about are the raising of those dividends. And again, to just give you the numbers, the dividends in the S&P 500 have gone up 9% per year for 70 years. Nothing has done that. That's the income. I'm not talking about the price appreciation. The increase in income is phenomenal. 3 times the rate of inflation. That's how you stay ahead. So even if a dividend of a kind of a growing company like Apple or Microsoft is less than 1%, when they grow that 10% a year, it's not that many years where that's an attractive dividend, certainly on the price that you originally paid. So we like those along with some of the higher dividend payers, like I mentioned, Simon Property Group. Blend the two together, and you're getting more than you are in a 10-year treasury, and you're getting growth of that income. That is what we're underlying the portfolios with. It doesn't mean we don't have the REITs we're talking about for stability, that when bonds become more attractive, we add those in. But bonds don't give you inflationary increases either. So the core of everybody's portfolio in retirement is going to be those dividend growers.
Okay, good. All right. Seems the Feds are always about 2 months behind in making adjustments to interest rates. Can the Feds over adjust?
Of course, they always overshoot. I don't know if it's because they're in government, and so government officials never seem to meet a crisis they can't overdo, overregulate, and then overshoot. I really don't know that it's because they're bureaucrats as much as it's just something that's hard to do, right? You just don't know when to stop. But I don't think that the Fed's on the right track here at all. I'm not an economist. They may be right. I just don't think it's the best move is to go out and destroy the economy. That's what they're doing. So how do we stop inflation? We crush demand. Or we shrink the money supply. And they're not doing that. They're talking about it, but at the rate they're doing it, it will take them 7 years. 7 years of what? Raising interest rates, crushing the economy to try to get a handle on inflation, I think is wrong. And so we'll see how it plays out. But my opinion is that I'm not optimistic about the Fed's ability to keep us out of a recession, which I believe is what the market's already telling me. Yeah, they'll overshoot. They always do.
I think that's all I have for now, Dave. Anything else?
That's awesome.
Yeah. Oh, wait, one more. What is cryptocurrency doing to the marketplace?
Nothing. It's not affecting stocks in any way, in my opinion. I don't think it's doing anything. It's in its infancy, and there's not much of it out there relative to the size of the markets. And of course, it had a big setback over the last year as many of them just blew up. They just blew up. Bitcoin's still around. It's a third of where it was at its peak. A little less than that, actually. But let's just say crypto world is not growing right now. There's not a whole bunch of new pet coins out there. That's going to be mine, so you can't steal it. It's already been copyrighted. I'm starting my pet coin very soon. So,
Good.
Okay.
Good. Yeah, I think that's it.
Well, that's awesome. Jen, thanks for organizing it. And thanks again. All of you, hey, we're here for you. I mean that. And if you have any questions about some of the stuff we talked about, comments, we'd like to have those as well. We're seriously. And if you have an idea of stuff you want to talk about and share, we'd also like to be able to address that as well. We hope that we're coming back on these timely and not doing too many, too few, if you have comments regarding that as well, okay? But times are changing, so look for some things out there as far as interest. We're able to do it now, but I know I'm a lot less interested in any of my cash being at the bank, earning 0.1. And you'll see more things in your portfolio and less cash, even if we're kind of building up some cash reserves for you, okay? Have a great rest of the day.